All right, let's jump right in. Welcome to today's explainer. We're tackling something that gets talked about constantly, but is almost always misunderstood: the relationship between gold and the US dollar. If you spent any time trading gold, you've probably felt like it just has a mind of its own sometimes, right? Well, what if you could peek behind the curtain? What if you could use macro-level data to actually time your trades better? That is exactly what we're going to master today. Okay, let's dive into this. Here's our roadmap. We're going to cover the macro relationship, myth versus reality, proxy pairs, cross-market filtering, and finally, some absolutely crucial risk management rules. Section 1, the macro relationship, 10 years of gold and the greenback. So we're taking a funnel approach here. We'll start super broad with a 10-year view, and then narrow it all the way down to the daily charts. To do that, we have to establish our baseline. It's basically a massive if-then scenario that drives so much of the global market. Look at it this way. If the US dollar index, the DXY, is flexing, showing strength and moving higher, that usually puts heavy downward pressure on gold prices. And the why is actually pretty simple. Gold is priced in US dollars across the globe. So when the dollar gets stronger, gold literally becomes more expensive for foreign buyers to get their hands on. Naturally, that kills some of the global demand. But flip that around. If the US dollar is weakening, well, that gives gold the breathing room it needs to rally. It's kind of like a giant seesaw. One goes up, the other usually goes down. Which brings us to Section 2, myth versus reality, the imperfect correlation. Now, what's really interesting about this is the myth we need to bust right off the bat. A lot of retail traders just blindly assume this seesaw is perfectly balanced 24/7. They think these two markets always mirror each other. But actually, scratch that. Reality is way different. The hard truth is, while they are inversely related most of the year, it is not a perfect one-for-one deal. Not even close. Look at the data from the start of the year. There were these distinct, weird little windows in February and July where the dollar and gold just stopped fighting. They essentially held hands and marched in the exact same direction. Both were rising at the exact same time. If you were just trading on autopilot, assuming they always move opposite to each other, those periods absolutely would have caught you off guard. So how do we actually protect ourselves from those unpredictable windows? We use this exact statistical threshold right here, positive or negative 0.80. Listen, the relationship between gold and the dollar doesn't always live at the extremes. For correlation to be considered strong enough to actually mean something, strong enough to help you build a real directional bias, it literally has to be above positive 0.80 or below negative 0.80. If it's just wandering around somewhere in the middle, like say negative 0.68, yeah, it's technically still inversely related, but it's totally not at an extreme. Those middle ground numbers, they're absolute trap zones. The signal just isn't strong enough to bet your capital on. Moving on to Section 3, proxy pairs, USD/SAR and USD/CHF. Okay, so you might be wondering, what if the gold DXY correlation isn't at that extreme 0.80 level? Am I just out of luck? No way. If that main signal is weak, we just look at proxy pairs for cross-market clues. First up, we've got USD/ZAR. That's the dollar against the South African rand. Now, South Africa used to be the undisputed heavyweight champion of global gold production, and that massive export legacy permanently tethered their currency to gold. Because of that tie, its daily correlation coefficient sits in an incredible negative 0.83. Next, look at USD/CHF, the dollar against the Swiss franc. Currency traders use this one all the time as a proxy if they don't have direct access to trade the DXY index itself. Its daily correlation with gold is sitting at a highly actionable negative 0.81. Because both of these proxies are chilling well below that negative 0.80 threshold, you can actually use the price of gold to help you figure out the direction of these specific currencies interchangeably. It's a real game changer. Section 4, cross-market filtering, charts, candles, and moving averages. All right, enough of the macro data and stats. Let's get our hands dirty and see how this builds on the charts. Check out what happens when we zoom into the daily time frame for gold. Ever since it hit that all-time high of 2075.11 back in August 2020, gold has just been grinding out lower highs, oscillating around this downward sloping trend line. But look really closely at these recent daily candlesticks. See those last four? They've got these long, lower wicks. So what does that actually mean? It shows us a massive liquidity grab. Basically, sellers are shoving the price down early in the day, probably reacting to morning dollar strength, right? But then boom, institutional buyers aggressively step in to scoop up gold at a discount. They buy those lows and push the price right back up before the close. That specific candlestick structure is a huge clue about real market sentiment, especially when we pair it with our macro data.
And that leads us right into our step-by-step order of operations for building a high probability bias. Step 1. You check the DXY or your proxy pairs. Ask yourself, is the correlation greater than positive 0.80 or less than negative 0.80? If yes, green light. Proceed. Step 2. Check the actual gold market structure. You're looking for clues like those long lower wicks we just talked about. Step 3. Watch your major moving averages. Right now, buyers are fighting to push the price above the 50-day moving average at 1782.25 and the big 200-day moving average at 1800.08. Think about this like BTC/gold style cross-market thinking. You're essentially using an external macro asset as a lie detector test for whatever local setup you're looking at on your screen. You're cross-referencing the environments.
Let's look at exactly how practical this gets. We've got two scenarios to digest here. First, the bullish breakout. If gold can successfully punch through that 200-day moving average at 1800.08, there is a clear open path for it to target horizontal resistance up at 1834. And because we already confirmed that inverse correlation, you would simultaneously be watching for your USD/CHF proxy pair to drop back down to 0.9200. On the flip side, what if we get a bearish rejection, meaning gold tries to push higher, fails, and the bears take the wheel? Price could tumble way down to previous lows around 1679.13. In that bearish setup, you'd immediately look for USD/CHF to rally up towards 0.9473. You are literally using gold's technical levels to map out the exact corresponding moves in the dollar pairs. How cool is that?
Section 5. Risk Management Rules. Protecting your capital.
Okay, this brings us to the final and, without a doubt, the absolutely most crucial part of this whole explainer. The rules that actually keep you from blowing up your account. So the crucial point is this. Macro momentum, correlations, these are just filters, period. You should never, ever trade a correlation blindly on its own. Like we talked about earlier, for a huge chunk of the year, the correlation between gold and the dollar just isn't strong enough to mean anything on a daily basis. You always have to apply strict risk management. You always have to confirm your macro bias with actual market structure, liquidity zones, and live price action before you hit that buy or sell button. And as always, remember that all trading involves significant risk to your capital. To wrap all this up and highlight the real value here today, by using one market as a lens to filter another, you are giving yourself an insane edge. You're improving your timing, you're naturally filtering out those choppy, low-probability trades that chop everyone else up, and you're keeping your local day-to-day chart decisions perfectly aligned with 10 years of macro momentum. When you use one market to filter the other, you are officially graduating from that retail mindset and stepping into true macro-level thinking. Sure, it takes a little extra homework, but the absolute clarity it brings to your charts, completely worth it. I want to leave you with a quick thought to test how you're doing things right now. Take a hard look at your own trading process and ask yourself, do you already check the DXY before you pull the trigger on a gold trade? Or do you usually just trade them completely independently in a vacuum? Seriously, think about how applying that strict 0.80 correlation threshold could totally change your outcomes this week. Thank you so much for hanging out with me for this explainer. Keep your risks tightly managed, and I will see you on the charts.